Hello, everyone. Welcome back to Boss Economics World, where we break down global news to explain exactly how the economic floor under you is being chipped at, whether by your friendly central bankers or your competent national leaders. Grab a seat, because today's agenda boils over worldwide. Ah yes, here we go again with the Fed, doing its most eloquent play on stage. Enter Federal Reserve Governor Adriana Kugler. She gives us a polite reminder that inflation, despite easing since the pandemic, isn't quite where it needs to be. What's the magic number, you may recall? 2%. The Fed is obsessed with this figure as if life itself depends on controlling inflation. And guess what? While 2023 ended in a somewhat good place economically, what good even means these days, the Fed just cut interest rates by a quarter point and signaled only 2 more rate reductions in 2025. Could this be the sweet relief investors have been praying for after last year's tightening? Sadly, don't rush to uncork that bottle of champagne just yet. Now, you may ask, why this hesitation? Why can't Powell just cut rates and finally get that speculative boom roaring again? The problem goes back to inflation. Sure, inflation has come down, but folks, the politicians and monetary elites, they can't fully accept it because it's not following a straight path down. Every time we think we're headed to price stability, one curveball after another pops up. The result? A labor market that still sings tunes of resilience despite unemployment inching up to 4.2%. The good old jobs market keeps showing signs of more life than anticipated, meaning people are still spending in quote-unquote stimulating the economy. But here's where it all gets dicey. With Donald Trump looming over the horizon, potentially ready to step back into the Oval Office, we've got more unpredictability. Future tariff wars anyone? If Trump, true to form, unleashes more tariff threats, market volatility isn't a question of if, but of how much. Global supply chains won't just clear up overnight, and inflation, should he go down that road, could rear its ugly head again. That's rate hikes lurking in the background despite today's dreams of cuts. Let's talk about the holiday that didn't arrive, the Santa Claus rally. Sorry Wall Street, but Santa decided he wasn't playing this year. 5 straight days of dropping markets swiping $1 trillion off share prices. And investors, instead of their typical cheer, could only finally muster some relief by buying the dip. Let's give a round of applause to everyone who decided Friday's 1.3% rise in the S&P 500 was worth breaking out the confetti. But on to the real insight behind this rally. Nasdaq 100 up 1.7%, manufacturing managed a comeback by 49.3%. It even topped estimates. But wait, hold on, sounds great, right? Well, not so fast. We're still sitting below the benchmark 50, and anything beneath 50 means we're technically still in a slow contraction that feels like walking through mud. A positive signal, yes. But the economy roaring back? Not by a long shot. The optimism for new orders rising since early 2024 may be the candy that keeps the wild bulls on Wall Street somewhat upbeat, but, again, this is likely short-term cheer after several harrowing sessions of bloodletting. Let's just acknowledge that one swallow doesn't make a summer, or in our case, one 1.7% rise doesn't really solve corporate revenue declines from weak consumer demand. Meanwhile, we turn our globe towards South America, where Argentina, yet again, serves us another drama fit for an economic soap opera. We get it, economic recessions aren't exactly anything new for Argentina. And while President Milei is fresh through the doors of office, managing to secure a modest yet significant $1 billion repurchase deal to replenish beleaguered foreign reserves with international lenders, it still feels like surgery with no anesthesia. Why are we blunt? Well, Argentina is fighting inflation that already exceeded 100% last year. Milei's fiscal austerity means shackling what could have been useful government expenditure to stimulate production or curb runaway inflation. Seriously, how do you cut back while trying to cure a nation's runaway inflation and devaluation? Argentina's peso itself has lost so much relative to steady currencies, and stabilizing it isn't exactly about turning a few dials, it's a multifactorial monster. Not to mention poverty is deeply entrenched, and dismantling currency controls sounds like a battle with both the undead and the living. Optimists shout confidence in Milei's next moves. They argue that he's on the verge of slowing inflation and crafting policies that'll, so the narrative goes, both stabilize the peso and boost economic growth before midterms. But with record-high debts, the road ahead will feel less like a sprint and more like an Ironman marathon. Let's switch to something a little more futuristic, cryptocurrency. Ah yes, initially riding that high post-election, crypto soared like rockets post-Elon Musk-style hype on steroids. But guess what? Reality isn't so forgivable. Investors withdrew a staggering $333 million from BlackRock's iShares Bitcoin Trust ETF. It's like the air hissed right out of the balloon after all that excitement. It's not surprising given how volatile the space has been, but it still serves as a reality check on the limitations of the post-election frenzy cooling down. Don't be shocked if risk appetite for crypto remains bumpy until regulatory clarity enhances. The dream of decentralized utopias dances at the edge of tech-savvy investors' imaginations, yet many in mainstream finance are finding this sector a little harder to bet on consistently. Next up, Canada. You'd think it was just ice hockey and maple syrup, but no, Pierre Poilievre, kissing babies and breaking deals, is now projecting a different vision. Conveniently posturing as Canada's Conservative Party leader, he's plotting a proposal with Trump, should he step back into office. His claim: if Canada roars ahead with approvals on new oil, liquefied natural gas, nuclear, you name it, produced on Canadian soil, the old US-Canada partnership will flourish. Why care? Because this plays directly into the rising electricity consumption powering America's next big boom, AI. The rising demand for power-hungry machine learning centers, data servers, and AI platforms is nowhere close to being small-scale. Oh, we mentioned Microsoft's $80 billion ongoing spree to build global data centers, just in the fiscal year alone. Half of that being pumped into the US itself. AI isn't just expensive, it's an energy guzzler. What's the irony? Right as we're scream-slashing fossil fuel usage, a semiconductor-led AI boom is coming like an unstopping tsunami, cranking the dials up again on fossil-reliant energy grids. Weird, right? Despite every call to greenify the planet, the machines to analyze whether we're green enough are eating juice like industry titans of yore. Hold on to your drinks now, because guess what? Surgeon General Vivek Murthy dropped a significant truth bomb on everyone, a quiet one. As it turns out, alcohol is killing us far more than we recognize. Over 100,000 cases of cancer linked directly to popular beverages like beer, wine, and spirits. And yet, 75% of the US population drinks weekly at some capacity. Whoa! Who'd have thought the six-pack you grabbed after work might have your funeral planner on speed dial? Not only that, $260 billion in alcohol sales could be under the microscope since stocks of drinks manufacturers tumbled following this announcement. Imagine all those hard-lobbying liquor companies scrambling to figure out their next marketing campaigns, trying to upsell while pushing strange disclaimers. The future is unclear in this particular vice-ridden, deeply culturally entrenched sector. Watch closely if government policies slowly start adopting actual cancer warnings on bottles, goodbye unchecked liquor sales growth in key consumer markets. Look guys, whether you're in Argentina, the US, Canada, or you're sipping on that lucrative bottle of red that might be rotting you from within, the economic situation we all face today is filled with contradictions and uncertainties. One day you wake up to interest rates rising, the next day rates are cut back a fraction, with even more to come once inflation supposedly behaves. All while the world is moving toward AI-driven economies, fueled, ironically, by old-school energy grids we just decided to phase out. What happens? Simple. More cuts, more chaos, more policy mistakes, and ultimately, that economic stability we always hoped for will seem like a distant mirage. Stay tuned as Boss Economics World continues to blow the whistle on all the wild moves happening across financial markets. Like, subscribe, and comment below on what you think about the mad world of economic policymaking we live in today. Until next time.